Yesterday, stock investors were caught by surprise. Today, they caught their breath. Stocks exhaled modestly today, one day after that big rally on the unexpected news. The Federal Reserve would continue buying $85 billion in bonds every month to keep the economy on track. Most on Wall Street figured the Fed would take its foot off the gas pedal, if only slightly. Well, yesterday, record highs for the Dow and S&P. Today, profit-taking, not just in stocks, but in bonds too, as yields rose. The blue-chip Dow stocks saw a 40-point pullback. The Nasdaq did manage a small gain of 5 points for a fresh 13-year high, but the S&P was down 3.
Some strong economic data out today were not enough to lift the markets. First-time jobless claims rose by 15,000 last week, but filings are still near multi-year lows. The Philadelphia Fed reported factory activity in the mid-Atlantic region surged to a 2.5-year high this month. And existing home sales rose 1.7% in August, hitting a 6.5-year high as potential homebuyers rushed to make deals before mortgage rates rose higher. And a reading on the economy's future health posted a solid gain last month as leading economic indicators rose 0.7% from the month prior.
So with stocks just off their record highs and some solid economic data just out today, does Ben Bernanke and his team of Fed policymakers know something about the economy that we don't? What are they worried about that the rest of us seemingly aren't? Hampton Pearson has more now on what the Fed didn't see in the economy and what it needs to before it tapers all that paper it's been buying.
The day after Federal Reserve Chairman Ben Bernanke and his fellow monetary policymakers delivered shock and awe to financial markets,
no taper. The Federal Reserve did not taper.
Economists and analysts are revising their playbooks for predicting just what will it take for the central bank to pull the trigger on tapering.
The Federal Reserve Chairman is very clearly saying, read my data.
In the 4 months since the Fed Chairman first mentioned gradually reducing its bond buying program, that data shows job growth has slowed to just 155,000 per month on average, and mortgage interest rates have increased a full percentage point, topping 4.8% last week, putting the brakes on the housing recovery.
The committee has some concern that the rapid tightening of financial conditions in recent months could have the effect of slowing growth.
Today, there was encouraging data showing existing home sales on the rise and the monthly average for jobless claims at a 6-year low. But the debt ceiling and budget standoff between the White House and Republicans and its impact on a fragile recovery is, Fed watchers say, also on policymakers' radar screen.
I think that it's the politics of it make everybody nervous, and the fact that the Fed is having to react to not only politics in terms of what's going to happen with the debt ceiling.
So for now, the Fed is on hold, awaiting the outcome of fiscal policy battles over the debt ceiling and budget to decide what's next for monetary policy when the Fed meets again at the end of October. For Nightly Business Report, I'm Hampton Pearson in Washington.